Yo, Bitcoin Bulletin fam, get ready for a rapid-fire crypto update that's gonna blow your minds. First up, we're diving deep into Bitcoin's $115,000 tug-of-war. Whales are accumulating like crazy as the market waits for the next big catalyst. Is this consolidation a sign of strength or a setup for a fall? We've got all the details. Next, we're talking about an institutional tsunami. Billions are pouring into Bitcoin as spot ETFs ignite a brand new era for cryptocurrency. This isn't just a trend, it's a fundamental shift changing how the world views digital assets. We'll break down who's winning and who's getting left behind. Then, we're going back to the roots with Bitcoin casinos. These early adopters were stress-testing digital play on the public ledger long before NFTs or plate-worn were a thing. We'll uncover the groundbreaking lessons they learned about trust, speed, and community that the entire gaming industry can still borrow today. And finally, Crypto Fitz is here to answer the burning question: can you actually buy a house or car with Bitcoin right now? We're breaking down the real-world spending power of your crypto. Don't go anywhere. Make sure you're subscribed and hit that bell so you never miss an update. Bitcoin's $115,000 tug-of-war. Whales accumulate as market awaits next catalyst. Bitcoin is currently locked in a critical battle around the $115,000 mark, a price point that's igniting intense speculation and strategic maneuvering among major players. This period of consolidation follows a massive rally, signaling a crucial test of the market's strength and its readiness for the next significant price discovery. This consolidation phase is far more than a simple pause. It's a battleground where institutional inflows meet profit-taking. The key players here are the whales, those large holders of Bitcoin. In August, whales holding 1,000 to 10,000 BTC offloaded an estimated $12.7 billion worth of Bitcoin, contributing to a price dip. However, a fascinating shift occurred in September, with mid-sized whales, those holding 100 to 1,000 BTC, beginning to accumulate, adding over 65,000 BTC in the first week alone. This divergence suggests renewed institutional confidence and provides a strong counterbalance to selling pressure. The holder retention rate hitting an 80.49% peak further emphasizes the conviction of long-term investors, known as hodlers. Public reaction and market sentiment are mixed but leaning towards optimism. While US Spot Bitcoin ETFs saw inflows of nearly $2 billion in September, retail sentiment on some platforms showed bearish trends around $114,000. The leverage ratio is at a yearly high, indicating trader confidence in an upward move. Crucially, softer inflation data and a weakening jobs market are fueling expectations of a Federal Reserve interest rate cut, a historically bullish sign for risk assets like Bitcoin. This consolidation is vital because it's forming a potential launchpad for new all-time highs, or, if support fails, could signal a deeper correction. Companies like Coinbase, Marathon Digital, Riot Platforms, and MicroStrategy are directly impacted, with their stock prices heavily correlated to Bitcoin's movement. But what does this $115,000 standoff mean for the broader market? And is this consolidation a precursor to something even bigger? Stay tuned as we break down the institutional tsunami that's reshaping crypto and discover how early Bitcoin casinos taught us invaluable lessons about gaming transparency. Institutional tsunami. Billions pour into Bitcoin as spot ETFs ignite a new era for cryptocurrency. The approval of US Spot Bitcoin exchange-traded funds, ETFs, has unleashed an unprecedented wave of institutional capital, driving billions into the cryptocurrency market and fundamentally reshaping Bitcoin's price trajectory. This landmark decision by the SEC has provided a legitimate pathway for mainstream investors and has ushered in an era of rapid institutionalization. On January 10, 2024, the SEC approved the listing and trading of 11 spot Bitcoin ETPs, with trading commencing the next day. This decision followed over a decade of applications and rejections, marking a pivotal moment. ETFs from giants like BlackRock's iShares Bitcoin Trust, IBIT, and Fidelity's Wise Origin Bitcoin Fund, FBTC, quickly gained traction. SEC Chair Gary Gensler cautiously stated the approval was based on legal interpretations and investor protection, not an endorsement of Bitcoin itself. The catalyst for this approval was a U.S. Court of Appeals ruling in August 2023 that the SEC failed to adequately explain its rejection of Grayscale's application. The market reaction was overwhelmingly positive. On their first day, the 11 ETFs saw $4 billion in trading volume, followed by billions in inflows. By September 2025, US Spot Bitcoin ETFs alone managed nearly $219 billion in assets, accumulating Bitcoin at a rate far exceeding its daily issuance. This demand has made ETF activity a primary driver of price discovery, shifting influence from retail speculation to sustained institutional flows. The most notable loser has been Grayscale's Bitcoin Trust, GBTC, which experienced billions in outflows due to its higher fees compared to newer, cheaper ETFs. This institutional flood has not only boosted Bitcoin, but has also dramatically altered the competitive landscape, creating clear winners and posing new challenges. But can you actually spend your Bitcoin on everyday purchases? We'll get Crypto Fitz's take on buying houses and cars with crypto next. Bitcoin casinos as early adopters. Lessons for the wider gaming industry. Long before NFTs or plate-to-earn became mainstream, early Bitcoin casinos were pioneering what digital play could look like on a public ledger. They weren't just using crypto for payments. They fundamentally rethought the player experience, focusing on trust, speed, and community, offering lessons that any gaming company can adopt. In the early 2010s, Bitcoin dice games became the proving ground for blockchain entertainment. Their simplicity was key: intuitive rules, transparent math, and quick outcomes. Features like faucets, which offered small free coin drops, provided a low-stakes entry point, turning curiosity into engagement. These casinos demonstrated that a public ledger could host real money games that were auditable, global, and always available. The core innovation was making games provably fair, allowing players to verify outcomes on the blockchain using hashes, seeds, and block heights, flipping the traditional casino model of trust us to verify it yourself. This ethos of don't trust, verify transformed fairness into a core product feature, a concept now echoed in mainstream gaming through visible drop rates, certified RNGs, and public patch notes. The speed of cryptocurrency transactions also revolutionized gameplay. Players could make numerous small bets rapidly, test strategies, or use autoplay without delays from payment processors. This rapid loop of click, result, repeat enabled longer, more engaging sessions and encouraged player experimentation. The economic model of microbets, where friction from costs and delays is removed, allows players to iterate and test ideas more freely, a principle directly applicable to free-to-play game designed for increased retention. Beyond mechanics, community was a significant growth engine. Early crypto dice sites featured chat windows, faucet tips, and leaderboards, fostering a culture where players shared knowledge and strategies. Veterans would guide newcomers on how to verify fairness using block explorers. This sense of shared experience and knowledge building is portable to any gaming platform, encouraging social interaction through daily challenges, community-curated tips, and tools for players to compare notes. This mirrors the communal aspects of beer culture, where sharing tasting notes and brewing tips strengthens the community. These early experiments in transparency and rapid engagement laid a blueprint for modern gaming, proving that less friction and more clarity lead to stronger player loops. But what happens when that transparency and speed meet real-world needs? Crypto Fitz is here to answer if you can actually buy a house or car with Bitcoin, coming up. Crypto Fitz Answers: can you buy a house or car with Bitcoin? With Bitcoin hitting new all-time highs and its legitimacy growing through products like spot ETFs, many are asking the crucial question: can you actually spend your hard-earned Bitcoin on significant purchases like a house or a car? Crypto Fitz breaks down the current reality of using Bitcoin for major expenditures. While Bitcoin's price appreciation has been dramatic, its use as a direct medium of exchange for large purchases like real estate or vehicles is still evolving and not as straightforward as using traditional currency. The primary hurdle is volatility. The price of Bitcoin can fluctuate significantly in short periods, making it risky for both buyers and sellers to agree on a fixed price. A seller accepting Bitcoin today might find its value has dropped considerably by the time the transaction is fully settled, or a buyer might regret spending Bitcoin that could have potentially appreciated further. Despite these challenges, there are ways to use Bitcoin for these purchases. Some real estate agents and car dealerships have begun accepting Bitcoin directly or through third-party payment processors. These processors typically convert the Bitcoin into fiat currency, like USD, almost instantaneously, shielding the seller from volatility risk. This means that while you might be using Bitcoin to initiate the transaction, the actual exchange of value often happens in traditional currency behind the scenes. This approach allows for the use of cryptocurrency while mitigating the price risk for merchants. However, the infrastructure for widespread adoption is still developing. For a house purchase, for instance, you might find a seller willing to accept Bitcoin, but the legal and escrow processes still typically require fiat currency. This means you'd likely need to convert your Bitcoin to USD, potentially incurring capital gains taxes on any profit made since acquiring the Bitcoin. Similarly, for car purchases, while some dealerships might accept crypto, it's not yet a common practice, and the conversion to fiat is often still necessary. Audience impact. The ability to spend Bitcoin on major assets is a key indicator of its maturation as an asset class. While direct acceptance is growing, the reliance on conversion to fiat highlights the ongoing need for more stable, widely accepted crypto payment solutions and clearer regulatory frameworks for large-scale transactions. Many in the crypto community are actively exploring and advocating for more direct crypto-to-asset purchases, viewing it as the next frontier in financial freedom. So, while direct spending is possible with caveats, the landscape is rapidly changing, paving the way for more seamless integration. This has been your Bitcoin Bulletin update. Don't go anywhere, we've got a lightning round recap and full call to action coming right up. And that's a wrap on today's Bitcoin Bulletin. We've seen Bitcoin consolidate around $115,000 with whales accumulating, spot ETFs bringing in billions and ushering in a new era for crypto, Bitcoin casinos pioneering transparency in gaming, and crypto Fitz explaining how you can actually spend Bitcoin on big purchases. If you found this update valuable, make sure to smash that like button, subscribe to Bitcoin Bulletin for more, ring that notification bell so you never miss a beat, drop a comment below with your thoughts, and follow us on all our social media channels. We'll see you in the next one.